After weeks of anticipation and tensions, Russia has finally made its move in Ukraine. Russia has so far targeted multiple cities in Ukraine and seems to be marching towards the capital, aiming for a regime change. Russia's incursion in Ukraine is nothing new. In fact, in 2014, Russia annexed Crimea, however, without much of a conflict. And since then, the eastern part of Ukraine has been subject to frequent conflicts with Russia through the separatist movement. Since the invasion, clearly financial assets suffered a sell-off. Volatility rose across most risky asset classes. Investors also bought risky assets as a hedge against this geopolitical risk. Let's look at some of the potential scenarios that could happen with this geopolitical conflict. In our view, the base case is that the Russian attack is likely to be limited both in scale and in terms of duration. That we ascribe a 60% probability, and associated with that, we anticipate a potential sell-off of roughly 15% in the equity markets. In terms of the impact, clearly the impact is the most severe for Russia, as most Western allies impose crippling sanctions on Russian corporates, financial institutions, as well as the central bank. Secondarily, Europe will have more collateral damage under this scenario, given its dependence on Russia oil and gas, and this is likely to lead to more elevated inflation and a potential slowdown. In terms of the economic impact to the United States, the impact is likely to be more modest, as the US have limited trade with Russia and limited dependence on Russian oil and gas. However, the US is still subject to global energy prices, which is likely to stay high under this scenario. Under a more severe scenario where the war ended up more protracted, leading to large civilian casualties, we expect a more severe market response, which could lead up to 25% sell-off in the markets. That we ascribe a probability of 30%. Sanctions will be imposed and Russia will be economically isolated from the rest of the world. This will lead to a massive economic crisis in Russia, and the corresponding impact on Europe is likely to be greater, especially if Russia were to unilaterally cut off its oil and gas supply to Europe. The impact on the US is largely transmitted through the stock market, as well as through higher energy prices, which will affect consumer confidence and cause inflation to rise even higher. Russia may be a fairly large economy with a total size of 1.5 trillion US dollars. However, Russia has limited trading relationship with the rest of the world, and the impact of this conflict and the associated sanctions is unlikely to come through trade, but through oil prices. Europe is very dependent on Russia for energy products. In fact, close to 30% of its oil and gas needs are fulfilled through Russia. So under a protracted conflict scenario, we expect Europe to suffer more economically and also face higher inflation. The banking sector is less exposed as compared to the past. With the exception of Austria, most other major EU countries have very limited exposure to Russian corporates and financial institutions. Hence, we expect an ongoing conflict is unlikely to tighten financial conditions materially or to create a systemic stress on the European financial system. How has the equity markets or financial markets reacted in an environment of ongoing geopolitical conflict? In fact, when we look back at prior geopolitical events such as the Gulf War, the Afghan War, the Iraq War, as well as the 2014 Crimean crisis, one thing stood out. Markets declined into an anticipation of a war. But as the war commenced, financial markets tend to bottom out into an actual invasion. The key takeaways of this analysis is that based on history, most geopolitical event risks will pass without lasting economic impact. Economic fundamentals, such as those relating to growth and inflation, will dominate and assert itself. As the broader conflict materializes, history also suggests that markets will be close to a bottom. As such, we recommend clients to start positioning into markets, whether through dollar cost averaging or through structured solutions given elevated level of volatility, which can be used to build defensive payoff in investments. Thank you, and for more information, please contact your senior client advisor.